Opendoor Technologies is trading live at $7.56, down about 2.7% on the day. The stock is sliding, hitting near its low of the session at $7.39 on fairly heavy volume of over 35 million shares. Now, the expectation when you see a stock like this, a name synonymous with iBuying, is that you're looking at a binary bet. The common narrative is that this company is either the future of real estate or it's a financial black hole that's one housing downturn away from total collapse. But the reality of what is happening at $7.56 is so much more complicated. This isn't just a bet on the housing market, it's a bet on interest rates, it's a bet on complex pricing algorithms, and it's a bet on a business model that is burning cash at a ferocious rate. The market is currently pricing this as a deeply flawed, high-risk investment. But it's also a market that has seen this same stock rocket 386% since the beginning of the year. The disconnect is massive. This isn't a simple story, it's a war between two entirely different futures. Let's establish the common ground, because anyone who has done any online investing or has just tried to buy or sell a house in the last few years understands the core problem Opendoor claims to solve. The traditional process is a nightmare. The expectation, the one Opendoor sold to Wall Street, was that it could use technology to provide instant, fair value cash offers, fix up the homes, and resell them for a small but consistent profit. It was supposed to be the Tesla stock of real estate, turning a clunky, analog business into a sleek, digital one. This is the story that got it a massive valuation and a cult following among many self-investing enthusiasts. But the reality, as the stock's collapse in 2022 and 2023 showed, is that this model has a potential fatal flaw. It is completely at the mercy of macroeconomic forces, specifically mortgage rates. When rates soared, the housing market froze, and Opendoor was left holding billions of dollars in inventory that was declining in value. That's the trauma the market is pricing in. The current trading action, this 2.7% drop today, isn't happening in a vacuum. It's a pullback from a massive run. Just a few days ago, the stock surged over 15% on a cooler-than-expected inflation report. Why? Because that report gave the market a hit of optimism that the Federal Reserve might be done hiking and could even cut rates in the future. Opendoor is not a normal stock. It is a leveraged bet on falling interest rates. A drop in mortgage rates does two things for Opendoor. It lowers the carrying cost on the $1.5 billion in homes it holds on its balance sheet, and it, in theory, unfreezes the housing market, allowing for more transactions. The entire business model hinges on volume. It needs to buy and sell homes rapidly. Today's slide suggests that post-rally excitement is fading, and the market is remembering the immense structural risks. Let's dig into that risk, because the numbers from their last quarterly report are staggering. In the second quarter of 2025, the company delivered $1.6 billion in revenue and, for the first time since 2022, posted an adjusted EBITDA profit of $23 million. That was a huge beat. It showed they had discipline, they were managing their costs, and they could, in a favorable environment, actually make this work. But here's the reality check. The guidance for the third quarter, which we're about to get results for very soon, was for an adjusted EBITDA loss of $21 million to $28 million. That's a sharp reversal. More concerning is the inventory. The company ended Q2 with $1.53 billion in homes, representing 4,538 properties. This was down 32% year over year. They've been de-risking, shrinking their inventory to survive. But at the same time, 36% of their homes had been on the market for more than 120 days. That's a terrifying number. Every day a house sits on the books, it's burning cash in taxes, insurance, and financing costs. This is why online investing in a name like Open is so different from buying Apple stock or Nvidia stock. Those are tech companies with high margins. Opendoor is a real estate company with razor-thin margins and massive, illiquid, capital-intensive inventory. It's more like a bank that holds houses instead of loans. This is not a stock for a passive, intelligent portfolio. You won't find this in Fidelity ETFs or Fidelity mutual funds that are focused on stability. This is a high-octane, speculative name for an individual brokerage account, one you watch on your Fidelity mobile app or Robinhood app with a pit in your stomach. The Fidelity trading platform might show you the technicals, but the fundamentals are all about the macro. And the analyst community is completely torn in the most bearish way possible. The consensus rating is a neutral or hold, but the price targets are all over the place and mostly way down. Way down. The average 12-month price target is a disastrous $1.87. Citi has a target of $0.70. Morgan Stanley is the high water mark at $6. This tells you that at $7.56, Wall Street analysts believe the stock is profoundly, fundamentally overvalued. They see the $2.3 billion in debt, they see the rapid cash burn, and they see a business model that simply does not work in a 7% mortgage rate environment. The current stock price is, in their view, detached from reality. But who is right? The 386% year-to-date rally or the analysts with their sub-$2 price targets? The market is a battle between momentum traders on the Robinhood stock trading platform and hedge funds looking at the balance sheet. This is the ultimate expectation versus reality stock. The expectation is that Opendoor is the last iBuyer standing. Zillow and Redfin, its two biggest rivals, famously flamed out, losing hundreds of millions. Opendoor survived. The bulls believe that by surviving, they've proven their pricing algorithms are superior and they are now poised to take the entire massive market. The reality is that they survived by shrinking, laying off staff, and managing to eke out a tiny adjusted profit in one quarter. Now they have to prove they can grow again, to scale up, in a market where home prices are at all-time highs but transaction volume has fallen off a cliff. Their new financial open house, which they are live streaming on Robinhood to attract retail investors, is a brilliant marketing move, but it also signals they need that retail enthusiasm to support the stock. The business model is simple on paper. Opendoor offers to buy a home with a cash offer. They charge the seller a 5% service fee. Then they make light repairs and list the home, hoping to sell it for more than their all-in cost. The contribution margin is the key metric here, and it's been volatile. It's the profit they make on a home after paying for the home and the selling costs, but before corporate overhead. That margin has to be high enough to pay for all their engineers, marketers, and executives. For a long time, it wasn't. The Q2 results showed promise, but the Q3 guidance suggests that margin is under pressure again. This is not a stock for a SoFi robo-advisor or a Fidelity wealth management plan. It's a stock for SoFi active investing, for traders who can handle 15% moves in a single day. Looking to the future, the scenarios are as stark as they get. Comment below with what you think is the bigger catalyst for Open, a 1% drop in mortgage rates or their upcoming earnings report. I'm very curious what people are watching. The bear case is simple. Interest rates stay high. The housing market stays frozen. Opendoor's $1.5 billion in inventory gets older, and they are forced to sell it at a loss, cratering their margins. Their cash burn accelerates, the $2.3 billion in debt becomes unserviceable, and the stock heads back to the $1 level that analysts are predicting. In this scenario, the 2025 rally was a meme stock echo, not a real recovery. The bull case is just as dramatic. The Fed pivots, mortgage rates fall to 5.5%, the housing market explodes with pent-up demand. Opendoor, as the last iBuyer, is perfectly positioned to capture this volume. Their algorithms, hardened by the downturn, are now razor-sharp. They buy and sell thousands of homes, their contribution margins stabilize, and revenue soars. The company proves it can be profitable at scale, and the stock doesn't just go back to its 52-week high of 1087, it challenges its all-time highs. This is the dream that keeps the investment thesis alive for those on investing sites and SoFi. So, as we watch open at 756, we are not watching a housing stock. We are watching a high-stakes financial technology company, one that is using billions of capital to make a leveraged bet on the single most complex asset in the world, the American home. The expectation